January of 2021. A video game company on the brink of bankruptcy. A group of amateur investors on Reddit. And Wall Street, losing billions of dollars in a matter of days. This is the story you know about GameStop. A perfect narrative of David versus Goliath, where, finally, the little guys beat the giants. But what if I told you that victory was never real? That you've been staring at the finger while the moon remains invisible? The story begins in New York, in the heart of Manhattan's financial district, where major hedge funds were betting against GameStop. It wasn't just any bet. It was a death sentence. More than 138% of the company's shares were sold short. Yes, you read that right, 138%. Mathematically impossible. Without the practice known as naked shorting, selling shares you haven't even borrowed, financial ghosts traded as if they were real. On the other side, in millions of homes spread across the United States, Europe, and even Asia, a crowd was organizing. The Reddit forum r divided by WallStreetBets became a digital battleground. More than 2 million people connected by one seductive idea. If everyone buys together, we can trigger a short squeeze, forcing hedge funds to buy back the shares at ever higher prices, multiplying their losses and everyone else's gains. Keith Gill, known as Roaring Kitty, became the prophet of this revolution. From his home in Massachusetts, he turned $53,000 into $48 million through GameStop call options. His YouTube analyses and Reddit posts weren't just about money, they were manifestos. Each video was a call to arms against a system that, since 2008, had gone unpunished. On January 20th of 2021, the stock closed at $39. 1 week later, $347, a jump of 788%. On January 28th, the price hit $483, some say even $500. A rise of more than 500% in just days. Trading volume was 130 times higher than normal. Daily volatility swung between 100 and 300%. It was chaos. It was beautiful. It was revenge. But then something happened that no one expected. On the morning of January 28th, in San Francisco, Robinhood, the platform that promised to democratize finance, hit the red button. Buying GameStop shares? Forbidden. AMC, BlackBerry, Nokia, blocked. You could only sell. And when you can only sell, the price can only do one thing: collapse. The official explanation came from Chicago, from the Depository Trust and Clearing Corporation. Margin requirements, systemic risk. A perfect storm of volume and volatility. Technical words masking a brutal truth. The game stopped when the little guys were winning. But here's what you were taught to believe. The small investors won. The minnows defeated the sharks. The people proved that, united, they could challenge Wall Street. It's a beautiful story, inspiring, perfect for documentaries and motivational books. Except for one question no one asked loudly enough. Who really profited when the dust settled? Let's go to the cold numbers. The New York-based hedge fund Melvin Capital lost 53% of its value, about $6.8 billion. It needed a $2.75 billion bailout from Citadel and $0.72 to cover its positions. The popular narrative stopped there. Hedge fund defeated, mission accomplished. But let's keep going. While Melvin was bleeding, other funds were swimming in profit. Senvest Management, based in Montreal, made $700 million. Mudrick Capital, in New York, pocketed hundreds of millions. They weren't on the Reddit amateurs side. They were playing the same hedge fund game, just on the right side of the bet. Total losses from the squeeze reached $12 billion. But who absorbed those $12 billion? The answer lies in a concept Wall Street knows well but rarely discusses. Wealth transfer is not wealth destruction. When someone loses in a trade, someone else wins. And the biggest winners are rarely the small investors who joined the party late. Think about the real mechanics. The stock rises from $20 to $483. When do you, an average investor, hear about it? When it's already at $100, $200, maybe $300? You buy in excitedly, believing in the revolution. The stock touches $483, and then, by February 5th, it's below $100. A 90% drop from the peak. Who sold at the top? It wasn't the ones posting "hold the line" and rocket emojis on Reddit. Let's go back to Chicago, to the discreet building of Citadel Securities. This company isn't an ordinary hedge fund. It's a market maker, an entity that profits from trading volume, not from price direction. Every stock bought or sold on Robinhood goes through Citadel via an arrangement called payment for order flow. Robinhood sells its clients' orders to Citadel, which executes the trades and keeps the microscopic difference between buying and selling. In January of 2021, with trading volume 130 times higher than normal, how many of those microscopic differences do you think Citadel accumulated? While Melvin Capital begged for a bailout, Citadel Securities, same company, different arm, profited from every frenzied move made by Reddit investors. And Robinhood? It later faced regulatory penalties, but during the chaos, it did exactly what the financial system required. It halted volatility at the precise moment. In Washington, D.C., congressional hearings were held. Keith Gill sat before lawmakers alongside Vlad Tenev, Robinhood's CEO. Questions were asked, concerns were raised. Nothing changed structurally. The David versus Goliath narrative fails in one crucial detail. It assumes there were only two sides. But financial markets are complex ecosystems with multiple predators operating simultaneously. While you were watching two gladiators fight in the arena, you didn't notice the others collecting bets from the stands. But there's an even deeper layer, a truth that corrodes the very structure of this story. Here's what the GameStop episode really revealed. It wasn't a system failure. It was the system working exactly as designed. Let's go back decades, to the 1970s, when brokerage regulations were dismantled in the United States. Transaction costs plummeted. Barriers to entry vanished. Free trading became possible. Sounds democratic, doesn't it? Finally, everyone could participate in the market. But every financial democratization hides one question. Democratization for whom? Free trading doesn't exist. Someone pays the bill. In the case of Robinhood and similar platforms, you're not the client, you're the product. Your orders are sold. Your moves are data. Your psychology is mapped by algorithms that know your behavior better than you do. Analysts at the Cato Institute in Washington pointed out something unsettling. Near zero interest rates since the 2008 crisis encouraged absurd leverage and a desperate search for yield. Hedge funds sold 138% of GameStop shares not out of irresponsibility, but because the system allowed and encouraged that level of risk. When the Fed keeps rates at zero, cheap money floods the market, and cheap money looks for increasingly extreme bets. The GameStop short squeeze spread like contagion. In California, AMC shares jumped 250%. Bed Bath & Beyond skyrocketed 63%. In Asia, Chinese platforms like Tiger Brokers discussed replicating the movement. In Hong Kong and mainland China, regulators watched nervously, calculating whether coordinated groups of traders could destabilize Chinese companies listed in the U.S. In Europe, British and Spanish lawmakers debated the risks of platforms that gamify investing, everyone reacting to the symptom, no one questioning the disease. Because the uncomfortable truth is this: the modern financial system is built on layers of abstraction so complex that the line between investment and casino has evaporated. Naked shorting, selling shares that don't exist, is technically illegal. Yet, it happened on an industrial scale. Payment for order flow creates obvious conflicts of interest but remains legal. Clearinghouses can halt the market whenever they deem necessary, but their criteria are opaque. And here's the insight that shatters everything. The GameStop revolt didn't expose the flaws of financial capitalism. It exposed its normal operation. A system where 138% of something can be sold, where free platforms sell their users, where extreme volatility is halted selectively, where funds can lose billions while others make billions on the same trade. That's not corruption. That's architecture. The Reddit investors didn't invade Wall Street. They were invited in, fed sophisticated tools disguised as simplicity, encouraged by empowerment narratives, and then watched the rules change mid-game. Because the rules can always change. That's the real lesson. Think about the cruel irony. Millions trying to punish casino capitalism using the tools created by that very capitalism, playing on platforms it controls, under rules it wrote. Like trying to rebel against gravity by jumping higher. Keith Gill turned 53,000 into 48 million. How many of the 2 million are divided by WallStreetBets members did the same? How many bought at $300, $400, believing in the revolution, and sold at a loss when the price collapsed? The data doesn't lie. A massive transfer of wealth occurred, but the direction of that transfer wasn't necessarily from the sharks to the minnows. The cultural legacy remains. A generation discovered that markets exist, that collective coordination can move prices, that narratives are powerful. But it also discovered, perhaps without fully realizing, that within the system, every revolt can be monetized. Every uprising can be turned into a product. Every act of subversion can be absorbed and resold as entertainment. So, when you hear the GameStop story, when you watch the documentary or read the book, when you cheer for the narrative of David beating Goliath, ask the one question no one asked. In a game where the rules are written by the casino's owners, where even hitting the pause button is allowed for some but not for others, where every move you make generates data and profit for invisible infrastructures, what does winning really mean? Maybe the real illusion isn't believing we won, it's believing we were ever playing a different game from theirs.